Happy Friday. I'm here today with Jamie Simpson of Proper Rate, and the interest rates have been in the news, so it's perfect time to bring in Jamie and break it down. So today we're going to talk about investment and second home loan products. So what are the current rates?
Okay, well, first of all, thank you for having me. Rates, it's been pretty fluid lately. Let me just start off with primary, just to get that out of the way. We hit a peak in October where we got up to a roughly 7.5. We are now just under 6% on the 30-year fixed. So we've had a pretty major reversal. And as long as inflation, and this goes along with investment and second homes as well, as long as the trajectory of inflation, if it continues to go in the direction it's gone, then rates are going to continue to drop, and that's regardless of what the Fed does in their future meetings. So for example, if the Federal Reserve raises the Fed funds rate by 25 basis points in the next month, as long as inflation continues to moderate, mortgage rates will continue to fall, regardless of what they do. So primary, we're looking at under 6%. Second homes gets a little more complicated. For years, Fannie Mae and Freddie Mac have treated primary and second homes the same in terms of down payment interest rates. That has changed in the last 18 months for a number of reasons. For a second home, we're most likely looking at about 7%, about a point, roughly a point higher than primary.
Okay.
And then for investment properties, it's going to be it's very, very similar to second homes right now.
Why do you think Fannie and Freddie look at investment and second homes in the same lane?
It's a great question. Roughly 18 months ago, Fannie and Freddie took a look at the concentration of primary investment in second homes. And what they saw was that in their view, they were straying from their mission of providing affordable housing for primary home buyers. Couple that with Airbnb and Vrbo and the temporary rental sites that people use that wasn't around 10 years ago. So there are a lot of people who own second homes who will use Airbnb, Vrbo for when they're not there.
Right, to offset their costs.
To offset their costs, which totally makes sense.
Yeah.
But from a lending perspective, Fannie Mae and Freddie Mac, the two previously government-sponsored entities, now government-owned, they see that as a risk, a higher risk.
Yeah. So speaking of costs, what are the costs that are involved with both the primary residence, your second home, and investment?
Sure. So generally speaking, our lender-related fees you're generally looking appraisal included. You're looking at a roughly $1,700 with the appraisal. And then title fees are going to vary by state. Here in Illinois, title fees, it depends on the purchase price and loan amount, but in the, let's just say $3,200 to $3,300 range. And then if you're buying in the city of Chicago, then the buyer is going to pay the City of Chicago transfer tax, which is $7.50 per $1,000 of the purchase price. So if a purchase price is $500,000, you take 500 times 7.5, and that will give you the transfer tax.
Right.
So all in all, in terms of closing costs, you're looking at roughly $5,000 to $5,500.
Right. Well, and when we were talking earlier, you said something about how, because I was asking for what would the rate, what would
Sure.
Hypothetical rate be for to buy in Fontana, and I was surprised at how many fees were involved with that. So can you talk about that a little bit?
Yes. So because of the concern on Fannie and Freddie's part of having too much concentration of second homes and investment properties, Fannie and Freddie are trying to they're mitigating their risk by charging more. So up until even about a year ago, primary and second home, you're going to get the same rate, same cost. Second homes now, if you put down 25% on a second home, the buyer will still, at least as of today, the buyer is looking at paying roughly 1 point in additional cost. So 1 point, if you ever hear that term, that is 1% of the loan amount.
Right.
So a $500,000 property, putting down, let's say a $400,000 property with 25% down, that's a $300,000 loan. 1 point, 1%, $3,000. So you're going to add that to the cost.
Okay. Sounds good. Well, this is eye-opening.
Yes. And the good, the positive thing is interest rates are coming down. Inflation is moderating.
Right. And actually, we talked about this too, that this would be a vehicle for that 2-1 buy down. I mean,
absolutely.
Not to,
No, you're right.
Go in a totally different direction, but this would be an opportunity that a buyer would want to use this because you can always refinance with a 2-1 buy down. So do you want to do a quick overview of that?
So a 2-1 buy down. So 2-1. So it's 2-1. So that means that now it's seller funded. So to make it easy, let's say that the market rate is 6%. The first year of the buyer's mortgage, the rate would be 2% below 2% below 6. So it would be 4% the first year. The second year it would be 5. And then years 3 and onwards, the rate would be the market rate of 6%. And again, the seller, it's seller funded. You are not locked into that loan. So
you can refinance it.
You can refinance anytime. 6 months after the buyer closes, if rates drop and the buyer wants to take advantage, that's not a problem.
Great. And what is so it's seller funded, so the buyer cannot make any contributions to it.
The buyer cannot.
So if I was the seller, why would I want to accept an offer that has this 2-1 buy down?
Well, what it does, it expands your buyer base.
Right.
So if you are marketing your property and you are offering the buyer to lower their rate for the first 2 years, that's a pretty big deal, especially right now. So hopefully incomes each year will go up.
And the rates will come down.
Yeah. So this is it's an effective way for the seller to contribute and get their home sold.
Right. Sounds good. Well, thanks so much.
No, it's my pleasure.
Yeah.
We'll do it again sometime.
Yeah, we will. All right. Well, have a great weekend.
Thanks, guys.